Hi, welcome to Digging into China. I'm Dong Shang. Today, I would like to introduce a ruthless official, the Chinese Communist Party's financial enforcer and the newly appointed chairman of the China Securities Regulatory Commission, Wu Qing. Public records indicate that Wu Qing was born in April 1965 and holds a Ph.D. in economics. In 2010, he held several positions in Shanghai, including Deputy Secretary, Mayor, and the Secretary of the Hongkou District Committee. He also served as the Chairman of the Board and the Party Secretary of the Shanghai Stock Exchange, and subsequently as the Vice Mayor of Shanghai. Since 2019, Wu Qing has been a member of the Shanghai Standing Committee of the Shanghai Municipal Party Committee and a vice mayor. In July 2023, he was appointed Deputy Secretary of the Shanghai Municipal Party Committee. In August, he participated in activities as the Deputy Secretary of the Shanghai Municipal Party Committee and Secretary of the Political and Legal Affairs Commission. In February 2024, he was appointed Secretary of the Party Committee and the Chairman of the China Securities Regulatory Commission. Now that Wu Qing has been in office for over 4 months, we need to examine whether his reforms in the capital market have been effective or if he has been recklessly enforcing his authority. Is his professional competence truly adequate? In this episode, we will thoroughly assess his performance. In February of this year, Wu Qing took on his role during a crisis, with the A-share market hitting a low of 2,700 points. If we evaluate his performance based on the A-share market, we can acknowledge that he has at least stabilized the Shanghai Composite Index at 3,000 points. However, have we ever considered why the A-share market can never seem to break free from the 3,000-point barrier? In other words, what is the fundamental issue that the A-share market truly needs to address? It's like asking when China's emperor will finally meet his end. Technically speaking, the core problem facing the A-share market is the absence of fresh capital inflows. It has become a realm of existing asset speculation. To truly overcome the 3,000-point barrier, the A-share market needs to evolve into a robust market that consistently attracts new investments. So, how can we attract new capital? Essentially, there are two main paths. Firstly, through economic recovery. If GDP enters a phase of robust growth again, it will increase corporate profits and dividends. This will draw both domestic and international funds into A-shares, allowing them to partake in the capital opportunities. The second path involves a fundamental change in the current unfair rules of the A-share market. Taking a cue from the US stock market, both institutional investors and individual traders should have equal opportunities for short selling, rather than restricting this right to a privileged few. This would prevent the market from being exploited as a mere cash cow by certain groups. In recent years, the US stock market has shown remarkable momentum, with the S&P 500 and the Nasdaq indices consistently hitting new heights. This stands in stark contrast to the stagnant performance of A-shares. Investing in the S&P 500 and Nasdaq indices is essentially a wager on the future of the US economy, placing trust in the strength of American technology. To attract new capital into A-shares, the first path, economic recovery, is not solely achievable by Chairman Wu Qing of the CSRC alone. However, the second path, changing the rules of the A-share market, is where his efforts should be directed. Therefore, the effectiveness and intensity of his reforms in this regard will be the sole criteria to judge whether he is a qualified chairman of the CSRC. Let's take a look at what Chairman Wu Qing has done since taking office. Since taking office, Chairman Wu Qing has primarily focused on cracking down on misconduct such as illegal shareholder sell-offs, insider trading by brokerage firms, financial fraud among listed companies, and irregularities in IPOs. The CSRC has issued hundreds of fines this year alone, reflecting an unprecedented level of enforcement. Despite these efforts, the Shanghai Composite Index still hovers around 3,000 points. This suggests that while Chairman Wu Qing's reform appear stringent, they address immediate issues rather than the fundamental problems of inadequate new capital inflows into the market. Let me provide a simple example. The CSRC has implemented strict regulations on the delisting process for A shares. Underperforming companies are classified as special treatment stocks. If their stock price remains below 1 yuan for 20 consecutive trading days, they are marked for early delisting. As of June, 20 A-share companies have been slated for delisting, with 9 having completed the delisting procedure and another 15 in the process of delisting. However, do you know the combined the market value of these companies? It's 16 billion yuan. And what is the total market value of A shares? It's 88 trillion yuan. So whether these companies are delisted or not, does it really impact the A-share market? Not really. It's almost negligible. Even with these underperforming companies delisted, A-share trading volume still fails to rise. Therefore, the core issue in the A-share market isn't that these companies draining liquidity. The real issue is that the true vampires haven't been expelled yet. So who are the real vampires then? This story begins with Wu Qing taking office in February of this year. In February 2024, the CSRC introduced 3 significant measures concerning margin financing and the securities lending operations. One of these measures involved suspending the expansion of security firms' margin financing and the securities lending capacities, gradually unwinding existing balances. The CSRC's crackdown on these operations in February helped pull the Shanghai Composite Index back from 2,700 points to around 3,000 points. From February to early June, daily lending volumes in margin financing remained restricted to below 50 million shares. However, starting in June, there was a sudden surge in margin financing lending. 280 million shares were lent on June 11th, 170 million on June 12th, and 130 million on June 18th. This uptick in margin financing activities is cited as a primary reason for the recent decline in the A-share market, which struggled to maintain the 3,000 point mark. The CSRC responded on June 16th, attributing this surge to existing margin financing transactions being rolled over, with fewer new loans and more repayments leading to a decreasing balance over time. Let me explain in simpler terms. The contract period for margin financing and securities lending usually lasts up to 6 months. For instance, if an institution began this business in January, their contract would expire in July. Now, these institutions may opt to renew their positions by borrowing again before the contract ends, effectively extending their holding period. The CSRC's announcement on June 18th informed us that this practice is approved by them, which is quite intriguing. This is because earlier we discussed the CSRC's February regulations, which aimed to gradually phase out existing margin financing transactions at the brokerage firms. Since the objective was to gradually reduce these transactions while allow extensions. Another conflicting issue is this. Considering the restrictions introduced by the CSRC in February, brokerage firms were regularly initiating margin financing and securities lending transactions each month before Wu Qing took office. Why did it take until June for us to suddenly witness brokerage firms engaging in widespread rollover transactions despite these restrictions being ineffective since February? Let's compare some data and the issue becomes clear. For instance, in August last year, the daily volume of margin financing and securities lending exceeded 10,000 shares, with one-day peak at 100,000 shares. According to the usual 6-month contract period, by late February this year, some brokerage firms should have been renewing and extending their positions. However, at the end of February, the daily lending volume was consistently below 1,000 shares. The obvious conclusion is that brokerage firms recognized their losses and began to phase out these operations. I find it hard to believe that the brokerage firms would willingly accept the losses and withdraw from margin financing and the securities lending operations if the CSRC had allowed extensions earlier this year. The cost of extending positions is minimal, usually just a bit of interest, which is quite low. Therefore, the only plausible explanation is that until June this year, the CSRC did not permit brokerage firms to extend expiring margin financing and the securities lending contracts. As a result, all firms chose to accept losses and exit these operations. However, starting from June, the CSRC suddenly relaxed these restrictions, allowing some brokerage firms to extend their positions or selectively permitting them to continue margin financing and the securities lending operations. This contradicts the reputation of Chairman Wu Qing as a butcher of brokerage firms. How could he suddenly soften his stance? Here, I must again remind authorities that there are generally only two possibilities when such regulatory actions occur. One possible scenario is that Wu Qing received directives from higher authorities instructing him to favor specific brokerage firms like CITIC Securities. CITIC Group holds the highest national level position among the central enterprises, ranking above the CSRC, which is at the deputy ministerial level. This hierarchical structure means that if Wu Qing meets CITIC Group's chairman, he must show respect and address him as a leader. In the Communist Party's hierarchy, it would be daring for a deputy minister level official to oversee a unit at the ministerial level. Therefore, it's plausible that Wu Qing faced pressure from someone too influential to confront directly, leading to a compromise, allowing contract extensions for certain brokerage firms while strictly forbidding them for others. This situation explains why we still observe daily margin financing transactions involving tens of millions of shares despite an overall decline in the balance. The second possibility is that Wu Qing has formed alliances with certain brokerage firms, offering them favors in exchange for personal gain. However, I consider this scenario less likely because Wu Qing, known for his uncompromising approach, has likely already antagonized both necessary and unnecessary parties. It's improbable that he would suddenly compromise now, as doing so would constitute a direct betrayal of higher authorities and lead to severe repercussions. Therefore, I believe the first possibility is more likely. To elaborate further, it's conceivable that this issue is being directly overseen by Xi Jinping himself. From Xi's perspective, the Asia market serves as a funding source for state-owned and central enterprises. Consequently, while Wu Qing can investigate rigorously, he must be careful not to misidentify targets or jeopardize Xi's allies. By now, it should be clear that Wu Qing's reputation as a brokerage butcher is largely just for show. Since taking office, his reforms in the capital market have mainly targeted small players and have been heavily publicized. The public see him as a cracking down on insider trading, rectifying IPO issues, and restricting major shareholders from offloading their shares, leading them to believe that a just official has arrived. However, these actions do little to truly enhance A-share trading volumes. They are mostly superficial measures. It may appear that the CSRC is highly active, issuing numerous fines and taking strong actions, but this is merely a tactic to deceive retail investors and give them false hope of an A-share market revival. In reality, the small maneuver in June revealed the truth. Just as the A-share stabilized at 3,000 points, some were already eager to cash out. It's now evident to everyone that Wu Qing is more focused on protecting the interests of the higher authorities rather than those of the retail investors. I maintain that a competent CSRC chairman must acknowledge the significant inequalities in the current A-share trading system. Some individuals have the privilege of short selling. allowing them to treat the Asia market as their personal ATM. As long as this privilege remains, any CSRC chairman will be seen as unqualified and unprofessional, rightly earning the disdain of all retail investors. Thank you for watching. Please like, leave a comment, and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.